Hello and welcome to the Weekly Outlook at XM.com. I'm Maria Pachurdiz, and joining me is Senior Investment Analyst Rafi Boyadjian. We'll be reviewing the week ahead. So Rafi, let's begin over in the U.S. with the upcoming FOMC meeting on Wednesday. In recent remarks, Fed Chair Jerome Powell said that the rise in yields was notable, but not so disorderly as to warrant Fed intervention at this point. What are we likely to hear at next week's meeting, and what data is coming out before the meeting that might be of interest to investors?
Well, Maria, it's definitely going to be quite an important meeting for the March meeting because, of course, we've had a lot of volatility in bond markets. So we haven't really, as you said, although in his very last remark, Powell was paying a little bit more attention than he had previously. So he did show some concern, but overall, Fed officials have been pretty relaxed about where Treasury yields are headed. So it's going to be important to see now what was discussed at the meeting. Are we going to see any changes in their statement? Are they going to refer to what's happening in the bond markets? And if so, are they going to signal any action? In particular, will Powell signal anything in his press conference, and just how concerned is he really about this surge in Treasury yields, which do lead to tight financial conditions, so it's not good for the markets. And of course, we're going to get that updated dot plot chart, and again, there's going to be quite a bit of focus on that, because if we do see some FOMC members bringing forward their expected timeline of when interest rates will begin to rise, that could upset markets. And even if Powell does try to calm markets as far as yields are concerned, any changes in the rate predictions could undo all of that. So we should expect quite a bit of volatility both in the US dollar and in Treasury yields. So that all of that means that we're not likely to see much of a response to the data coming up, although retail sales numbers on Tuesday will be quite important because it will show us where consumption is headed, especially now that we had that stimulus from December, and then we've got more stimulus coming up. On the whole, though, much of the focus will be on the Fed and on Jerome Powell.
Okay, if the Fed signals that it won't allow financial conditions to tighten much further, what reaction are we likely to see in commodity-linked currencies such as the Aussie, Kiwi, and Loonie?
So yeah, a lot what will happen to those currencies will depend on what the Fed will signal. So if the Fed says enough to calm bond markets and we see Treasury yields falling back, that would definitely give a big boost to the Aussie, Kiwi, Loonie, and also other currencies such as the Euro as well, because we did see a big drop in those currencies in March. They had a very strong bullish run for almost a year now, but then this surge in US yields did produce quite a significant correction in those currencies, and so a lot is depending on what the Fed is going to signal. We will have some data coming out of those countries. For example, Australian job figures on Thursday will be quite important. We've got GDP numbers coming out of New Zealand as well, so they could have obviously produced some knee-jerk reaction, but on the whole, what those currencies, how the week will turn out for those currencies will very much depend on what's going to happen, what the Fed will do to the dollar and to Treasury yields.
Moving over to the UK now, the Bank of England will meet on Thursday. So far, the bank has followed an approach that is similar to the Fed's in terms of its reaction to the jump in yields. Do you think that will keep the same approach going forward, and what would that mean for sterling?
So we're not expecting any significant changes from the Bank of England. Like the Fed, as you said, the Bank of England has been fairly relaxed about what's happening in bond markets, because they do see it as a natural reaction to the improving economic outlook. So we're not, and also worth mentioning that the March meeting, we don't have any new updated economic forecast. There's no press conference, so those meetings you tend to not produce any significant deviation in the policy statement. But nevertheless, if we do see any tweaks in the language as regards to perhaps the Bank of England wanting to stress its forward guidance to make it more clear that its existing guidance of when it expects to begin tightening stands as is. They're not planning on at all on beginning to tighten earlier than anticipated. So those kind of tweaks to the language will be watched, and of course they would have quite a bit of an impact in the pound and in gilt markets as well. Overall, though, we're not expecting anything dramatic from the Bank of England just yet. So it's probably the next meeting in May that's going to be more significant.
And finally, the Bank of Japan will meet on Friday. And although no change in policy is expected, we'll get a review of the bank's monetary policy strategy. What are we likely to hear from Governor Kuroda, and what reaction should we expect in the yen?
So there's been a lot of rumors about the Bank of Japan's policy review. So the aim of the review is to make their QE program and yield curve control program more sustainable, given that it's taking much longer than expected to lift the inflation to targets. So this program has ended up running for far longer than anyone expected. So they want to make it more sustainable. So there's several things that they we're likely to see. So, for example, they could reduce what portion of the reserves will be charging negative rates. They've already done that once in the past. Before they could do that again to make it even more sustainable. But the main thing that's under focus, under the spotlight, is the whether or not the Bank of Japan will change the band within which 10-year yield is allowed to fluctuate. At the moment, 10-year Japanese government bond yields can fluctuate plus or minus 20 points around zero. Now, we've already heard from the governor, Haruhiko Kuroda, that there's no plans on widening this band, and so that really is all that markets wants to hear, because that pretty much means that the yen, the Japanese yields will be capped around zero, so that will continue to depress the Japanese yen. So if you get confirmation of that, then that's definitely going to be negative for the yen. It will pretty much underscore the yen's bearish outlook. So that's really what everyone is really looking out for. The other risk, of course, they might possibly make some changes to their ETF program, and that could have an impact on Japanese stocks. But other than that, the other changes won't really be quite as significant as to the expected announcement on the yield band.
Rafi, thanks so much. And thanks for joining us at XM.com.